and welcome to another Envision Capital Bond Boot Camp. I'm Marilyn Cohen.
I'm Alex Anderson.
And we're here to talk about the food fight in aisle 3 for municipal bonds. I know that that's a little dramatic, Alex, but that's exactly what's happening.
There's a ton of demand these days for municipal bonds. Hence, the yields are pretty low.
Well, and it all goes back to the new tax bill where the cap of $10,000 on state and local tax has really crushed high net worth and medium net worth individuals.
Yeah, people are increasingly looking for homes to shelter the income that they earn.
So if you take a look at the blue states, California, New York, Illinois, Connecticut, they can't issue enough municipal bonds in order to fill the demand. So let's talk about some data points, yields that are out there.
Well, yesterday California issued a general obligation deal, and to get a 2%, you had to go out to 2027. So that's an 8-year bond, and you're only getting 2%. That's pretty rich right now.
And I think coupled with that, Alex, is the fact that the yield curve is so flat, meaning 1 and 2 year bonds are not yielding all that much more than 3 and 4 and 5 and 8 year bonds.
Yeah, you really do not get paid very much to go out in maturity.
So here's the rub on all of that. It pays to stay relatively short term, 1, 2, 3 years, because you're not getting any more than maybe 0.5% pickup in yield to go out 8 years. But if we go into an economic downturn, or even worse, a recession, you're going to be rolling over those bonds at even a lower yield.
Absolutely. I think keeping municipal bonds short gives you a little bit more flexibility.
It does. And I think that anybody who's in a state that has high state tax, Illinois, New York, Chicago, not Chicago, sorry, Massachusetts, California, anywhere that you have to pay a high rate, municipal bonds fill the bill for income, and if you are selective, safety and security.
Absolutely, totally agree. Municipal bonds are a valuable part of people's investments, and it's particularly important if you're in a high-tax state.
Let's just talk real quickly, Alex, about the difference between owning individual munis versus a muni ETF or a municipal bond fund.
Well, I think individual bonds are much safer because ETFs have some dangers. One is redemption risk.
Yeah, and when everybody's in this food fight, like I said, and everybody's going into munis, what happens is you think you're locked and loaded in a yield in a municipal bond fund, a state-specific fund, but as more people flow in, the manager has to buy additional bonds at today's lower yields, higher prices, and you see a distribution cut, that's for sure.
Absolutely. I think with ETFs, there's a preconception that they might be safe because they have underlying bonds. But in the end, if everybody's hitting the exit door at the same time, the ETF price can really get hit.
Exactly. So our words of wisdom today, individual municipal bonds are best. If you want to shelter your state and federal income, then individual munis will do that, assuming that you are selective.
Absolutely. I was going to say be very picky when it comes to selecting municipal bonds.
I'm Marilyn Cohen.
I'm Alex Anderson.
Thanks for joining us.